Hey everyone, I'm an analyst with Talk Tickers. Today, we're going to pull back the curtain on a really critical accounting term, one that can signal some serious trouble after a big company merger: goodwill impairment. Look, if you're a serious investor or studying for your CFA, you absolutely have to know this stuff. So let's break it all down.
You've seen the headlines, right? Some massive company suddenly reports a billion-dollar loss out of nowhere, and the stock just tanks. Well, a lot of the time, the culprit is something called a goodwill write-down. So what is it really? It's the story of a deal made in the past, a premium that was paid, and, well, a promise that didn't quite work out as planned.
All right, so here's our game plan for today. We're going to start with the basics: what goodwill even is, then we'll get into what triggers a write-down, how you calculate it using the modern one-step test, how it actually hits the books, and, this is the most important part, why we as analysts care so much about it.
So let's start at square one. Whenever one company buys another, you almost always see this huge asset pop up on their balance sheet called goodwill. But what is it? I mean, what is this premium that companies are willing to pay millions, sometimes billions for, that you can't even touch? Okay, so the official by-the-book definition says goodwill is the amount you pay for a company that's over the fair market value of its assets minus its liabilities. It's what we call an intangible asset. You can't see it or feel it, but trust me, its value is very real.
You know, the easiest way to wrap your head around this is with a simple analogy. Think about buying a house. You pay for the land, you pay for the building. But if that house is in an amazing neighborhood with a fantastic reputation, you'd probably pay a premium for it, right? That extra money isn't for the bricks, it's for that untouchable value. Goodwill? It's basically the exact same idea, but for a business.
And this really gets to the core of what you're buying with that premium. It's not the factories or the inventory. No, you're buying the stuff that makes the business special. Things like its powerful brand name, its super loyal customers, its incredible team of employees, or maybe some unique technology. It's the secret sauce that makes the whole business worth more than just its parts.
But here's the big question. What happens when that secret sauce kind of loses its flavor? What happens when the value just evaporates? That's when we have to start talking about impairment. So impairment is the official accounting process for saying, hey, that business we bought, it's not worth what we thought it was anymore. It's a formal admission that the future value we paid all that extra money for has started to fade. Now, companies have to check for this loss in value at least once a year. But, and this is a really crucial point, they also have to run a test immediately if a triggering event happens. Think of these as unexpected red flags that something might be seriously wrong. So, what kind of events are we talking about? Well, it could be something external, like a big recession. Or it could be internal, like losing a huge customer, seeing demand for one of your main products just collapse, or even a huge sustained drop in your own company's stock price. Any of these could ring the alarm bell.
Okay, so a triggering event happens. The company's pretty sure the value of that acquisition has dropped. How do they actually measure the damage? Well, that brings us to the modern, streamlined way of doing things, the one-step test.
It actually used to be a more complicated two-step process, which was kind of a headache. But back in 2017, the Financial Accounting Standards Board, FASB, they simplified the whole rule. It made the entire process way more direct and a lot easier to follow.
The beauty of the new test is just how simple it is. Seriously. You take the part of the business you acquired, what accountants call the reporting unit, and you compare its current fair market value to what you have it listed for on your books, the carrying amount. If the book value is higher than the real-world value, boom, that difference is your impairment loss. It's that direct. The only catch is the loss can't be bigger than the total amount of goodwill you recorded in the first place.
And just a quick note for those of you who analyze global companies, it's good to know there's a slight difference between the US rules and the international rules. The core idea is the same, but under IFRS, they test at a slightly different level. They call it a cash-generating unit, and they compare the book value to something called the recoverable amount. It's a similar concept, just be aware of the different terminology.
All right, so once that impairment loss is calculated, it has to be made official. It has to be recorded. And this is the part that makes investors and analysts really sit up and take notice, because this is where the damage actually shows up on the financial statements for everyone to see.
And you really shouldn't underestimate how big a deal this is. This isn't just some bean counter shuffling numbers around. As the quote says, it's truly one of the most consequential entries a company can make. It's a public signal that a major strategic move has underperformed.
The accounting entry itself looks pretty simple. You debit an expense account, the goodwill impairment loss, and that flows straight to the income statement. Then you credit the goodwill asset account, which reduces its value right on the balance sheet. Deceptively simple, but incredibly powerful.
So the absolute bottom line is this. A single journal entry directly hammers a company's profit for the year, and at the same time shrinks the total value of its assets. It's a real double whammy to the financials.
And here is a rule you have got to remember, because it's critical. This is a one-way street. Once goodwill is written down, it can never be written back up, ever. Even if that business unit stages some kind of miraculous comeback, the loss is permanent.
Okay, so this all brings us to the final, and frankly, the most important question of all. Why is this such a huge deal? Why do analysts and investors care so much?
Because a goodwill impairment is never just an accounting entry. It's a signal. It's a story. It tells you that a huge acquisition may have been a failure. It can point to bad decisions by management or a total failure to integrate the new business properly. It might even mean they just plain overpaid from the start. For any analyst, and especially for a CFA charter holder, this is a massive red flag that tells you to start digging now.
And as always, just a quick reminder for everyone, this is not financial advice. We're providing this explainer for informational and educational purposes only.
So I'll leave you with this to think about. The next time you're looking at a company's annual report and you see a massive goodwill balance, or even worse, a big impairment charge, I want you to ask yourself, what story is this balance sheet telling me about this company's past and about the decisions its leaders have made along the way?